Here's something most investors don't want to admit. The best time to look at a stock is when everyone's scared of it. Right now, Amazon is down from its highs. Airbnb is getting beat up by regulation fears. And Google, a company that literally controls how the world finds information, is trading like the AI revolution is going to destroy it instead of power it. So today, we're going to do something most YouTube finance channels won't. We're not just going to tell you these are great companies. We're going to run the actual numbers. And then we're going to tell you the real price, not the story, the price, where each of these actually makes sense to buy. Because you can own the best business in the world and still lose money if you buy it at the wrong price. That's what separates investors from gamblers. I've got 3 stocks. I've got the data. And in the next 15 minutes, you're going to know exactly where I stand on each one. If you're serious about building real wealth and not just watching stock tickers go up and down, hit subscribe. We drop content like this every week. No hype, just the process. Let's get into it. Okay, stock number 1, Amazon. I know what you're thinking. Amazon? That's your big idea? Hear me out. Because most people think about Amazon and they picture the brown cardboard box on their doorstep. And yes, that's real. It's a massive business. The biggest online store on the planet, with millions of orders every single day. But that's not why Amazon is actually interesting right now. Amazon is not a retailer. Amazon is an infrastructure company that happens to also sell you everything you need online. Let me explain. They have 3 real engines here. First, e-commerce, the store. Second, AWS, Amazon Web Services, which is cloud computing. Companies like Netflix, McDonald's, and thousands of others rent computing power from Amazon. Think of it like a storage unit. You don't build your own warehouse. You rent Amazon's. And right now, every company building AI needs more and more of that computing power. AWS is growing fast because of it. Third engine, advertising. When you search for something on Amazon, those sponsored results at the top, companies pay for those. That business is now generating billions of dollars a year. Most people forget it even exists. Here's where we get real. Market cap right now, about 2.4 trillion, not cheap. Net income last year, 77.7 billion. That's real money. Free cash flow, 7.7 billion. Now, stop right there. Because if you're new, that gap is going to alarm you. How does a company make 77 billion in profit, but only 7.7 billion in actual cash? The answer is capital expenditures. They are spending aggressively to build AI infrastructure, data centers, physical capacity. That spending is crushing free cash flow right now. Is that a problem? Or is it an investment in the next 10 years of growth? That's the real question you have to answer before you buy this stock. Gross profit margin, 50% and climbing. AWS gross margins? Around 90%. Every new AWS contract is almost pure profit before overhead. Revenue growth, 21% a year for the last decade. It's slowing, 11% over the last 3 years. But for a company this size, that's still incredible. Here's my concern. From a price to free cash flow standpoint, this stock looks expensive because free cash flow is artificially low right now. If Amazon's AI infrastructure spending doesn't generate the returns they are projecting, that number stays low, and the valuation stays stretched. You are betting on execution here. That Amazon deploys this capital, generates massive future returns, and free cash flow normalizes upward. If that happens, you're a genius. If it doesn't, you overpaid. Running my 10-year analysis, I modeled conservative revenue growth at 4, 8, and 12%. I got more aggressive on margins, 8, 12, and 16%, because I think profitability is genuinely improving. PE assigned, 22 to 28. That's premium, but Amazon has earned a premium multiple. My output, low price of 110, high of 497s. Middle case, around 250. It's trading around $237 right now. That's almost exactly at my middle case. For me personally, that's not enough cushion. I want a margin of safety. I've got it on my watch list at $200. That's where I start paying real attention. At today's price, it's not a screaming buy. It's a watch and wait. Set your price. Be patient. All right, Amazon is massive, global, dominant. Our next company is also massive, but in a completely different way. And here's the thing. I actually own 5 of them. Stock number 2, Airbnb. And I'll be upfront. I have skin in this game. I personally have 5 properties listed on Airbnb right now. So I understand this business from both sides. I'm a user and I'm a host. Here's the thing people miss about Airbnb. They don't own a single property. Not one. They are a technology platform sitting between 2 groups of people, hosts with space to rent and travelers looking for a place to stay. They take a small cut of every single booking on both sides. And there are now over 5 million hosts and 8 million properties listed globally. That is an asset-light model generating extraordinary cash. People think of Airbnb as a booking app. It's actually one of the highest quality businesses in the market right now. Here's the proof. In the last 3 months of 2025 alone, 122 million nights were booked through their platform. They generated $4.6 billion in free cash flow last year. And the gross margin? 83%. Return on capital over 5 years? 30%. Last year alone, 44%. That's exceptional. Find me another mega cap business with that profile. I'll wait. Market cap, $80 billion. Enterprise value, $82 billion. That $2 billion difference is basically their debt. And they can pay off that debt with a single year of free cash flow. 5-year average free cash flow, $3.26 billion. Last year, $465 billion. The trend is going the right direction. Debt level, 0x free cash flow. That is one of the lowest I've seen. They are essentially debt-free. Now, let me be honest with you because I said I'd tell you the real story. Regulation is a real risk here. New York City, one of the biggest travel markets on the planet, essentially banned short-term rentals unless you're physically present during the stay. That happened because the hotel lobby got to lawmakers. It could spread. Other cities could follow. I also had a personal experience recently where a bad faith renter left a 1-star review on one of my properties. Airbnb had a written record that the reviewer broke their own platform rules. They still wouldn't remove it. That's a platform trust issue that, at scale, matters. These are real gripes, but the data still shows a company with incredible economics, massive moats, and almost no debt. My 10-year model, revenue growth of 5, 8, 11%. Profit and free cash flow margin, 30, 35, 40%. And I think that could actually be conservative. PE multiple, 16 to 22. Output, low price of 110. High, 290. Middle case, 181. It's trading around 130. That's below my middle case. Guys, this is interesting. I have cash secured puts on Airbnb right now to get in at a lower price. The question is whether this is a business I want to own for a decade. And honestly, if you told me Airbnb didn't exist in 10 years, I'd need a major reason why. At 130, this is worth serious attention. Not a blind buy, but it's in the zone. Drop a comment below right now. Do you use Airbnb more as a traveler or a host? Or both? I read every comment. All right, asset-light platform business with incredible margins. Our final stock today is a completely different animal. It's 4 businesses in one. And the market is pricing it like it's about to lose everything. Let me show you why that's probably wrong. Stock number 3, Alphabet. Most people just call it Google. And look, I get the fear. People are saying AI is going to destroy Google search. OpenAI, Perplexity, all of them coming for the search ad model. The stock is down from its highs. Sentiment is negative. But here's what the bearish crowd is conveniently ignoring. Google isn't one business. It's 4. First, search. Still processing 90% of the world's queries. Still growing. Businesses are still spending more on search ads every quarter, not less. Second, YouTube. 2 billion monthly active users. The biggest video platform on the planet. Advertisers are pouring money in. That business alone would be worth hundreds of billions as a standalone. Third, Google Cloud. 3rd biggest cloud provider globally. Growing fast. High margin. And just like AWS for Amazon, every AI workload needs infrastructure. 4th, Waymo. Self-driving robo-taxis already running in US cities right now. This isn't a concept. It's operating. Most people completely forget Alphabet owns this. But it could be the most valuable thing they have in 10 years. If you're shorting Google because of ChatGPT, you're betting against all 4 of those businesses simultaneously. That is a very bold bet. Market cap, $387 trillion, big number. Free cash flow, $73 billion last year. 5-year average, $68 billion. A net income, $132 billion. Yes, the gap is there. Same as Amazon, same reason, cloud infrastructure investment. Gross profit margin, 60%, and climbing. Bottom line profit margin was 25% over the last decade. It hit 32% last year. They are getting more efficient as they scale. Revenue growth, 18% per year over the last decade, 12% for the last 3 years. PEG ratio, that's PE divided by earnings growth rate, is sitting below 1. That means the growth rate is outpacing the valuation. That's a signal worth paying attention to. Here's my concern: valuation. At $387 trillion, you're not getting this cheap. 2 of my 8 financial pillars are flagging on valuation right now. And the AI disruption to search is real. Not guaranteed, but real. If people shift even 10% of their search behavior to AI tools, that hits ad revenue. You have to be honest about that possibility. My 10-year model, revenue growth of 5, 9, 13%. Free cash flow and profit margin, 25, 30, 35%. PE 20 to 26. Output, low price of $175. High, $554. Middle case, 316. It's trading near $306 right now, essentially at my middle case fair value. So, is it cheap? No. Is it a disaster? Absolutely not. This is a fair price for an exceptional business. If you have a long time horizon and you're comfortable owning one of the world's most dominant companies, this works. If you want a bigger margin of safety, set a watch at $200 to $80 and wait for a pullback. For me, Google is a high-quality business at a fair price. I'd rather wait for a good price than overpay. But I'm not going to tell you this is some obvious sell either. All right, let's bring it together. 3 stocks, 3 different situations. If I had to rank them by where I see the best risk-adjusted opportunity right now, number 1, Airbnb. Trading below my middle case fair value. Incredible margins, almost no debt, high return on capital. The regulatory risk is real but manageable. This is the one I'm watching most closely right now. Number 2, Amazon. Near fair value based on my middle case. The story is real. AWS, advertising, AI infrastructure. But the free cash flow gap is telling you something. Be patient. Wait for a better entry. There's no shame in being on the sidelines at $200 and ready. Number 3, Google. Priced about right for what it is. If you already own it, hold it. If you're looking to start a position, it's not urgent. But the long-term thesis is extremely strong. Here's the thing I want you to walk away with today. The market is going to scare you into either buying things too fast or selling things too early. Every single one of these companies has a real story, real earnings, real advantages. The question is never just what you buy. It's at what price. Buying a great company at the wrong price is still a mistake. Buying a good company at a great price is how wealth actually gets built. Know your number. Set your watch list. Be patient. If this breakdown helped you think more clearly, smash the like button. It genuinely helps us reach more investors who are trying to do this the right way. Subscribe if you want this process every single week. We dig into real numbers, real companies, no hype. And right now, click the video on your screen. I ranked 7 stocks I believe will outperform the market's top names over the next decade. A full year in, the results are surprising people. Go watch it now. Thanks for your time. See you in the next one.